AM Best in mid-March announced plans to conduct stress testing for the insurance companies it rates in the wake of the COVID-19 pandemic to gauge its immediate impact on financial strength. Here to discuss the results of those tests is Mahesh Mistry, a senior director in AM Best Rating Services London office. And Mahesh, overall, what's the biggest takeaway from the tests?
The insurance industry is very well capitalized at the moment, and that's shown by our assessment of the BCAR scores, which shows median BCARs across all of our global ratings in the high 40 percentage point mark. Now, this level is significantly above the strongest threshold of 25%. So when we evaluate the companies under the stress test, what we are finding is that 75% of the rated population are still within their existing BCAR category, although it must be noted that there are significant variability amongst the segments that we have looked at. Most notable is the effect that the BCAR scores have had on the US life and health segment, which is taken given the high mortality and asset exposure that they have, in addition to, say, smaller companies with a smaller balance sheet size and those companies that are operating in higher country risk tier. So on average, we are seeing most of the market move between 10 to 25 percentage points based on the assumptions that we have made.
What exactly did AM Best look at in the testing?
Yeah, in addition to the stress testing, we also sent out a questionnaire to all of our rated clients. So that was our first point of call. We wanted to understand how companies are operating in the current environment. Are they operationally active? Can they do their business on a day-to-day basis? But it was also there to understand how they are managing their business. What type of scenarios have they considered in relation to the pandemic, and how those stresses are impacting the company to get a feel of the underlying exposures that the company have. We also overlaid that with an assessment of liquidity that we would require on companies as well. And this would be done through an internal exercise looking at specific metrics, in addition to the liquidity stress test that companies are also conducting. In terms of the stress test itself, we decided to apply an underwriting and investment shock to the company. So on the underwriting side, we decided to increase the effect on mortality, and that was assuming, say, 2 lives per every 1,000 insured on top of the existing risk factors that we have, which would be taken through available capital. In addition to that, we decided to increase to a moderate level the loss ratio for health and commercial lines. For health business, which was increased by 5%, we decided to exclude vision and dental and other supplementary health from this calculation, as during the lockdown, people are less likely to visit the doctor or the dentist. And as a result of that, some of the ratios may not be impacted. On the commercial side, we took a blanket 5% increase across all commercial segments, with the exception of some personal lines like motor warranty on there. Now, this won't take into consideration the spikes that we are seeing today, which I can come on to later, but it just gives a broad, moderate increase in the loss ratio. On the asset side, we decided to take haircuts to most of the asset classes. So for equities, real estates and other assets, the haircut was 35%, indicative of what we had seen during the market declines in the first quarter of this year. In addition to that, we decided to give a haircut of 10% to mortgage loans, and we decided to downgrade all bonds by one factor, one category on the BCAR for all corporate and government bonds. In addition to that, we made some adjustments to available capital. So for soft capital elements, typically we give credit for embedded values, the value of in force that companies have in their books, and we give up to 50% credit for the economic value of life business, and we took a haircut of that as well. And finally, we decided to look at the level of credit we give for hybrid debt in our model to see if any adjustments need to be made there. And what this provides us is an important analysis in terms of what the sensitivities are to any particular rating unit.
Now, when you drill down into regions or segments, did anything different emerge?
Yeah, there were some differences between the segments that we looked at, but the main understanding is that the insurance market is well capitalized. And when we look at the median BCAR scores pre and post test, we were not seeing that much difference, say, within the US P&C market, within, say, the EMEA region, the Asia Pacific region, and Latin America. Where we found the most change was in the US life and health segment, which one would expect given the exposure to mortality and asset risk there, in addition to the companies that are operating in higher country risk tiers. Now, within these tiers, we generally have higher charges in the BCAR, and rather than them being exposed to underwriting risk, they have a higher concentration or exposure to asset risk there. Now, it must be noted that we are applying a standard baseline stress test here, and it is giving us the sensitivities, and the landscape is changing all the time. So while some companies may have performed very well on the test, we still need to monitor them going forward. And those that have performed more poorly, we still need to look at those in a bit more detail to refine our assessment even more. We did not take into consideration, say, risk mitigation strategies that companies may have as well, in addition to some of the spikes we are seeing today in the market. And what's going on with, say, governments supporting liquidity within the market today, and the reinterpretation of some contract clauses.
Now, the report notes that the testing did not take into account a scenario in which contracts could be voided. Mahesh, could you discuss that dynamic?
Yeah, the baseline stress test was done on a number of predetermined factors to give us an understanding of where the sensitivities for each individual company lies. Now, the profile of every company can be quite different from one another. So what we are finding now is that there is a lot of discussion, there is a lot of talk about what is included, say, in business interruption contracts. And each, say, country, each product is being, say, treated slightly differently. So we are well aware of what is going on in the market, and we are monitoring the situation going forward. And obviously, we will need to adapt what we currently have in the stress test where applicable for those companies that may have greater impact to any change in the market environment, where we may see spikes in their claims experience, which may be due to the interpretation of contract clauses, but could be due to other factors as well.
So along those lines, is AM Best planning additional stress tests in the near future?
Yes, so at present, we have this standard baseline stress test. Part and parcel of the rating activities that analysts go through is to apply stress tests and the stress tests that they deem necessary for analysing companies. In relation to COVID-19, what we are going to do is obviously to keep monitoring the situation going forward, and where appropriate, we will run further scenarios down the road to assess companies and the impact that it will have. Items like, say, the resurgence of the pandemic, say a second or third wave, is quite important. Spikes in claims activities due to event cancellations, workers' compensation, credit insurance and travel insurance as well, in addition to the reinterpretation of contract clauses. We must also look at the liquidity situation in the market as well, so we'll be closely monitoring that, in addition to any indirect exposures to holding companies or non-affiliated companies as well.
Thanks, Mahesh.
Thanks, John.
That was Mahesh Mistry, Senior Director in AM Best Rating Services London office. And I'm John Weber for AM Best TV.